Hello all, and welcome to this legal English course that will help you prepare for the TOLES Foundation Exam. This is Unit 7, the language of banks. And in today's lecture, we will cover the topic of banking. In other words, we will talk about the main operation you can carry out in a bank. In a bank, you can take out a loan. In Italian, we say accendere un finanziamento, but you can also make a bank withdrawal, which means to take money out of a bank account. And you can do this at the ATM machine, for example. The ATM machine is that machine that is generally placed outside of the premises of a bank, or we can say outside of the premises of the branch office of your bank. But in a bank, we can also open a bank account. We can make a bank deposit. We can deposit cash or a check. But we can also apply, that means formally request to receive. We can apply for a credit or a debit card. Now let's start our analysis with what we need in order to take out a loan and what this generally entails. When we take out a loan, the bank, when a borrower takes out a loan, the bank gives the borrower a large amount of money, and he or she has the duty to pay the money back to the bank over time with interest. So in other words, we have someone, an individual who, not only an individual, also companies take out loans. We have someone, a subject that receives money from a credit institution. This subject is called the borrower. And we have a credit institution that gives money to someone and is called the lender. The borrower receives a sum of money that is called the principal, and the borrower will have to pay back not only the principal, but also interest. Interest is a sum of money that is calculated on the principal. Interest, we say, accrues on the principal. And the borrower has to repay, to give back this sum of money, not altogether, but over time. Over time means that the borrower doesn't have to give all the money back altogether in what we call a lump sum at a future specific date, but it'll be likely that the borrower will have to repay the loan within an agreed date and in the way that has been agreed between the lender and the borrower. Normally, the sum, the loan, is repaid in monthly installments, which is a fixed payment that is made by the borrower to the lender on a specified date each month. So the borrower, after being granted with the loan, will have to pay each month a monthly installment to the lender. So when a borrower takes out a loan, he or she has to give back to the lender not only the principal amount, but also the interest that accrues on the principal. Interest is, in other words, a small percentage of extra money that is calculated on the principal, while the principal is the money that you originally agreed to pay back and the money that you received from the bank. Put it simply, interest is the cost, the fee that you have to pay for borrowing the principal. In the English law, when we talk about interest, we generally make a distinction between simple interest, that is based on the principal amount, and compound interest, that is interest based on the principal and on previously earned interest. In Italian, compound interest is interessi composti, or in other words, anatocismo. So before granting a loan, a bank, we know that has to be really sure that the borrower will repay the loan will repay the loan in time within the agreed date. So therefore, loans are generally secured, which means that borrowers have to provide a form of security for the lender. Lenders require borrowers to provide securities. So since many borrowers default in repaying the loans, so they don't pay the loans at all, they don't repay the loans, or they repay the loans in a much longer period of time, then borrowers are required to deposit assets or to, however, give a guarantee of repayment. They have to make sure, they have to provide the lender with a guarantee that they will repay the debt. This asset or guarantee is what we call security of credit. And the security is, in other words, something of value that is given to the lender by the borrower to support his or her intention to repay the loan. In the case of a mortgage, for example, when we buy real estate, the security we provide is the property that the loan is being used to purchase. So if we take out a loan in order to buy an apartment, that apartment will become my security, will become the security that the lender provides the credit institution with. So what happens when someone wants to start this kind of credit? So in order to take out a loan, the first thing that someone needs to do is to apply for a loan. I mean, to formally ask to be granted a loan. First of all, you have to check whether you are eligible for it. Do you have all the requirements that are needed in order to be granted a loan? Part of this process will be carried out by the aspiring borrower. But most of the process, most of the checks will be carried out by the credit institution. Most lenders, in fact, will check your credit history in order to determine how likely you are to repay your loan. In other words, they will check your credit worthiness. They will check whether in the past you defaulted on loans or if you managed to repay all your debts. So after you file your application, you formally deposit your application, and your application has been approved, you will receive the money generally within a week. And from that point, as the borrower has the duty to make all the payments when they fall due. A payment falls due when you have to pay that sum of money. And generally, when we take out a loan, we have to pay monthly installments. And another duty is to not fall into arrears. When you fall into arrears, it means that you didn't pay some monthly installments. Another thing that we can do, another operation that we can carry out in the branch offices of a bank is to open a bank account. Of course, there are many different types of bank account available, but the most common ones are the current accounts or the savings accounts and the business accounts. Now, why do we need a bank account? Because some clients don't even know that they might need a bank account, especially young people. You can use a current account to help you manage your money day-to-day expenses. For example, you can pay your bills, electricity, or other expenses you have. But you can also receive money. For example, you can receive your salary on your bank account. And a bank account will help you keeping track, like controlling the money that is going out and is coming in your bank account. So your debits and credits. Remember to never confuse the word debit with the word debt. A debt is a situation in which you are when you owe money to someone. A debit is only the fact that is simply the fact that you paid for a service. So there is money leaving your bank account. And when we receive our bank statement at the end of the month, we will see both all the credits, so the money that arrived in, that were put into our bank account, but we will also see all the debits, so all our expenses, in other words. Nowadays, banks offer mainly online banking, so we don't generally need to go to the premises of a bank. But there are still many branches that are available throughout the country in case you need to talk with a bank clerk, that is an assistant, someone who helps us with the management of our bank account. But we might need the services of an account manager, someone who helps us really properly manage in the proper way our assets. However, generally, it is the savings account that help people earn interest. So we open a savings account when we want to earn a bit more money with the money we already have. However, some current accounts can also earn you interest, can also give you the possibility to have some extra money. So you can earn interest on the money you have in the account, but as I said before, it is likely to be a bit less than what you would be able to receive if you open a savings account. When you open a bank account, you generally get what is called a checkbook. A checkbook is a sort of a book with all the checks. Checks can be used to make payments, although nowadays it's not very frequent, but still there are some types of payments that must be done by giving checks. You may also be granted a debit card. Of course, banks have to carry out extra checks in order to see whether you are eligible for a debit card. And once you receive a debit card, you can use that to make payments in shops, but also at ATM machines. And you can also use it to withdraw money, so to take money out of a bank account. Sometimes you may agree with your bank to have an overdraft arrangement. So you have to arrange this in advance when you open your bank account. And this is another type of access to a kind of credit. So what is an overdraft? An overdraft occurs when there isn't enough money in an account to cover for a transaction. Remember, it's an operazione economico-finanziaria, or a withdrawal. So you want to make a transaction, but you don't have enough money in your bank account, or you want to withdraw money, but you don't have enough money in your bank account. However, the bank allows the transaction anyway. So essentially, an overdraft is an extension of credit from the financial institution that is granted when your account reaches zero. Now, the overdraft is very important because it allows the account holder to continue withdrawing money even when the account has no funds in it, or it has insufficient funds to cover the entire amount of the withdrawal. An overdraft in Italian is scoperto. So an overdraft fee è la commissione di massimo scoperto. Okay, so it's the amount of money that you have to pay the bank because of the fact that you, put it simply, you borrowed money from the bank. So once you open a bank account, every month you receive what is called a bank statement, which is a piece of paper that you may also receive electronically, and it covers a specific amount of time, usually a month, sometimes a year. And this document shows you all the activity on your account for that specific period of time. So The type of activity that is shown on your bank statement includes information such as the deductions, the debits, things that we paid for, but also the deposits, the credits, the money that you received that landed on your bank account. And they also show your average daily balance or the monthly balance. The balance is another word that indicates the outstanding sum of money on your bank. So what remains after I consider all the credits I received, all the debits I managed to create. And what is left after calculating all the credits and the debits is my balance, the money that I'm still allowed to use that is still mine in my bank account. So the bank statement is also a good way to check your balance. So the money that you have in your bank account. Okay, so this is the end of our lecture. Thank you very much for your attention, and bye for now.